Hello, greetings, and welcome to Dividend Blasters. This is our 60-second video, and our topic today is strategic dividend investing. What are some of these buying opportunities that are currently available in the healthcare sector? That's right. I'm going to go through and share with you my methodology for identifying a handful of what I believe are buying opportunities to jump on at this time in the healthcare sector. This is the third of these videos that I've done. I did one on consumer staples, and then more recently, I did one on the industrials sector. So let's jump in. But before we do, a little bit of housekeeping, a disclaimer. I'm not a financial advisor, so what I say should not be taken as financial advice. The purpose of this video is for information and education. It reflects my own personal opinions, my research, and my background as an independent investor for more than 30 years. So please do your own research and consult a financial advisor prior to making any financial investment decisions. So this is how I approach this. Basically, the same approach that I did on the previous two videos. I looked at the Sector Spider ETFs, and I think that this is a wonderful resource. As you may or may not know, State Street Bank and Trust Company manages and administers 11 ETFs, and they all reflect each of the major sectors in our economy. Today, I am going to be looking at the healthcare sector, or basically its ticker symbol XLV, healthcare. And I'm going to go down a level and look at some of the key stocks in that healthcare sector. And I'm going to take a look at uh, price activity year to date, whether it's up or down, what the dividend performance is. And I'm also going to look at the PE ratio. And even more importantly, I'm going to be looking at profitability, specifically levered cash flow, free cash flow margin. And I'm going to basically share with you my picks, if you will, of what I believe are good investments at this time. Let's press on. So these are the 11 ETFs. And you know what? You can actually buy these ETFs. You can go buy them from your online broker, and any one of the 11. And as I mentioned, we already talked about consumer staples, XLP, and we talked about industrials in the middle, XLI. Right above that, healthcare, XLV. That is what we are covering today. What you're going to see is that healthcare makes up about 13.27% of all these 11. And all these 11 add up to the S&P 500. Let me just pivot back one bit. As you're going to see, that for healthcare, XLV, they're down about 3.5% year to date. And this is as of yesterday, October 17th. So my focus has been really on what has gone down year to date and to find buying opportunities. Now, just because something has gone down doesn't mean it's a buying opportunity. Uh, may not be a good investment, and that's what we're going to cover. And I actually have chosen some that have actually gone up year to date a little bit. So we're going to jump into that. So let's look at healthcare. As I mentioned, healthcare makes up about 13.27% of the 11 sectors in the S&P 500. They closed yesterday at 130.99. This ETF. There are 65 stocks in this ETF. If you wanted to buy the ETF, as I mentioned, it's fine. The expense ratio is competitive. It's 0.1%. You can see the price performance information here. For the last 12 months, you can see they're actually underperforming the S&P 500 a little bit. And then year to day, or I'm actually looking wider horizon, the 5 years, it's actually much closer. So take a look at that. And that's really just for context purposes. What I'm going to do now is I'm going to share with you the 65 holdings that are in this sector. Let's go. So basically, the one that is weighted the most in this sector is United Healthcare, the healthcare provider, health insurance company. It is weighted at a little more than 10.2%, followed by Eli Lilly, the drug company, a little under 10%. Then everybody's favorite, Dividend king Johnson & Johnson, about 7.73%. Another drug company, Merck, 5.44%. Another drug company, as we all know, formerly the sole patent owner of Humira, 5.44%, or I'm sorry, 5.42%. Then Thermo Fisher Scientific, 3.85%. Pfizer, well, they're a big drug company. We all know that they played a major role in the COVID vaccination uh, game, 3.8%. Then Abbott Labs, 3.29%. Then the drug company Amgen, 3.13%. Then Danaher, 2.86%. Then another drug company, Bristol Myers Squibb, 2.47%. Then another healthcare provider, Elevance, 2.26%. Then Gilead Sciences, 2.06%. Intuitive Surgical, 1.99%. Medtronic, the medical device company, 1.99%. Vertex Pharmaceuticals, 1.96%. CVS, the pharmacy and health insurance chain, 1.9%. Cigna, 1.89%. Stryker, 1.87%. Regeneron Pharmaceuticals, 1.84%. Zoetis, 1.65%. Becton Dickinson, 1.55%. It's a third of them. Let's keep going. Boston Scientific, 1.52%. Humana, 1.32%. McKesson, 1.26%. HCA Healthcare, 1.01%. Now we start to go below 1%. Edwards Lifescience, 0.88%. Biogen Inc., 0.8%. Centene, 0.8%. IQV, 0.75%. IDEX Labs, 0.74%. Agilent Technologies, 0.68%. Cencora, 0.64%. Dexcom, the diabetes treatment, 0.64%. West Pharmaceutical Services, 0.59%. Moderna, we're familiar with them, also a vaccine provider for COVID, 0.59%. GE Healthcare Technologies, 0.54%. Cardinal Health, 0.49%. Metter Toledo, 0.47%. Zimmer Biomet Holdings, 0.46%. Steris, 0.45%. Molina, 0.43%. ResMed, and they do a lot of medical device equipment, especially in the CPAP area, 0.43%. Illumina, 0.43%. Next and last panel, Align Technology, 0.41%. Laboratory of America Holdings, 0.37%. Hologic, 0.35%. Cooper Companies, 0.34%. Baxter International, 0.33%. Waters Corp, 0.31%. Quest Diagnostics, I see these guys all over town in their trucks picking up lab samples, 0.26%. Revity, 0.27%. Viatris, I've heard a lot about Viatris, 0.23%. Biotechne, 0.22%. Insight, 0.22%. Charles River Labs International, 0.2%. Insulet, 0.2%. Henry Schein Inc., 0.19%. Teleflex, 0.19%. Catalent, 0.17%. Universal Health Services, 0.16%. Biorad Labs, 0.15%. Dentsply, Sirona, 0.14%. Organon and Company, 0.09%. And last but not least, DaVita, 0.08%. Folks, that is all 65 of the stocks in the healthcare sector. Now I'm going to share with you price performance year to date, which have gone down, which have come up. Let's jump right in. And as I've mentioned, just because something has come down does not mean it is necessarily a buying opportunity. And just because something has gone up, it does not necessarily mean it's overpriced. So basically, I'm going to go through the list quickly, and I'm going to share with you the price change year to date since January 1. And this is through yesterday, October 17th. Insulet is down 53.8%. Moderna down 48.8%. I mean, some of these are really getting hammered. Organon down 39.63%. Baxter International down 37.26%. Pfizer, wow, down 35%. Illumina down 35%, ResMed down 32%, Dexcom down 30%, Insight down 28.8%, Metler Toledo down 26.88%, Waters Corp down 25.52%, Agilent down 24.89%, Revity 24%, Teleflex 23.4%, CVS down 22.7%. Quest Diagnostics down 21.5%. Bristol Myers Squibb down 20.5%. Zimmer Biomet Holdings down 17.61%. Biotechne down 17.25%. BioRed Labs down 16.51%. Abbott Labs 16.04% down. Viatris down 14.91%. Centene down 13.28%. Charles River down 11.56%. Thermo Fisher Scientific down 11.29%. Johnson & Johnson down 10.8%. Universal Health Services down 10.5%. Henry Schein down 10.1%. Elevance Health down 9.8%. Danaher down 9.55%, and AbbVie down 8.9%. And you know what, folks, what you're going to notice is I still show the index weight. So you can see where they sit in the composition of this sector. I'm showing the last price as of Tuesday, October 17th, and the range for the last 12 months. All right, let's go to the next panel. And it's just the shaded ones that are down. So let's go through that. Gilead, they are down 7.75%. Medtronic down 7.68%. Hologic down 7.47%. Merck down 6.14%. The Cigna Group down 5.8%. Edwards Life Science down 4.48%. Biogen down 3.43%. IQV down 2.88%. Dentsply Sirona down 1.41%, HCA Healthcare down 0.23%, and DaVita down 0.13%. So those are all the ones that are down, and it's about 2/3 of them that are down, and maybe a third that have gone up. And remember, at the aggregate level, they're down about 3.5%. So let's cover the unshaded ones that have actually gone up year to date. Cooper Companies, they're up 0.28%. LabCorp of America up 0.58%. United Health, the behemoth, 1.48% up. Becton Dickinson up 2.14%. Humana up 2.35%. Intuitive Surgical up 3.32%. Catalent up 3.35%. IDEX up 5.29%. Molina Healthcare up 7.73%. Stryker up 8.02%. Boston Scientific up 8.28%. Amgen up 9.23%. Cencora are up 12.76%. GE Healthcare Technologies up 14.56%. Regeneron Pharmaceuticals up 16.93%. Zoetis up 19.54%. Cardinal Health up 20.54%. Steris up 21.31%. McKesson up 21.37%. Align Technology up 29.14%. Vertex Pharmaceuticals up 29.51%. And these last two are not typos. West Pharmaceuticals up 63.93%. Eli Lilly up 68.55%. And I think you can attribute Eli Lilly's increase to the spike in the use of some of these diabetes treatments and weight loss treatment drugs, injections or shots that a lot of America is getting on. So anyway, what I'm going to do now, before I go through my methodology, I'm going to share with you my list of, I want to say 10 stocks that I believe are buys to date. Most of them are down price wise. A couple of them are up. And I'm going to go through that methodology. But first, I'm just going to give you the list right now. Ready? Here they are. So the first one Baxter International, ticker symbol BAX. Pfizer, ticker symbol PFE. Quest Diagnostics, ticker symbol DGX. Bristol Myers Squibb, ticker symbol BMY. Johnson & Johnson, ticker symbol JNJ, the Dividend King. Elevance, ticker symbol ELV. They are the healthcare provider behemoth. Not as big as United Healthcare, but pretty doggone big. Next one, AbbVie, ticker symbol ABBV. We do know that they had the corner on the Humira market, but my understanding is they got other drugs in the pipeline. Gilead Sciences, ticker symbol GILD. Medtronics, ticker symbol MDT. And then the last is Amgen, ticker symbol AMGN. That is it, folks. It is the 10 that I have identified as being good buys at this time. And how did I do it? And before I go through a little bit of a deeper dive, I looked at what I thought were investments that, if they are down, I'm looking for a price decrease that is uh, good and sufficient, uh, and also a competitive PE ratio. When I say competitive, I want to see a PE ratio that is better than its peers and competitors in this sector. I'm also looking for a dividend performance that is solid. I typically want to see a yield of 3%. I want to see a dividend growth rate of more than 5%. I want to see a dividend growth streak of at least 5 years. And I want to see a payout ratio in the range of 20 to 60%. Um, and I'm going to be looking at levered free cash flow margin. And what I'm doing is I'm basically doing a comparison of each of these stocks versus the market sector. Are they performing better? Do they have better levered free cash flow margin than everyone else here? That's what I'm looking for. And I'd say let's jump into it right now. So here we go. And I'm going to share with you 3 panels that show you which ones I'm choosing. So remember, the first 6 or 7 columns reflect price. And if they are shaded, that means that they have gone down in price. Now, I'm not choosing all of them. I'm just choosing the ones that are, I believe, good investments. So once I look at price, I'm going to look at dividend performance. I'm going to look at cash flow, and I'm going to look at PE valuation. And the way you get selected here is if you are green across the board. Now, you know what? You can be white or unshaded in the index and price categories. Uh, there's not a lot of them, but there's a few of them. Most of them are priced down, so we're buying the dip if they are good value. But if they have green in the dividends, all of the dividend fields, so dividend yield, dividend growth rate, growth streak, payout ratio, as well as levered free cash flow margin, and PE ratio, if they are green, they get selected. If any of these get a red anywhere, they're eliminated. They're eliminated. So if you have a dividend growth rate of 0%, or if it is negative because there's been a dividend cut, or if you have a growth streak of less than 5 years, you're going to get a red if it's like 0 or 1 or 2 years. If it's 3 or 4 years, you probably get a yellow. If you get a yellow, it doesn't mean you're eliminated, but I'm probably not going to select you. If you have a levered free cash flow margin that is negative, you're going to get a red. If you have a levered free cash flow margin that's positive, but it's less than your sector median peers, you're probably going to get a yellow and you probably won't be selected. If you don't pay a dividend, I'm probably not going to select you if you see NAs in there. Now, it doesn't mean that I don't buy stocks that don't pay dividends. I do, but they're typically um, stocks that I believe have a real shot at going ballistic price wise. Here I'm looking for dividends. So that's what I'm looking for. So you know what? Which ones did I eliminate? I eliminated Insulet Corp. They had a negative levered free cash flow margin, and I'd say that PE ratio is way too high. 81.5 is extremely high relative to the sector median. Uh, Levered free cash flow margin's negative, so minus 4.08% is less than the 0.55% they're out. Organon is out. They have a 0% dividend growth rate or CAGR, and they only have a growth streak of 1 year. So they're out. Illumina, they're doing some exciting things in the biogenetics field, but that levered free cash flow margin is extremely negative. It's 93% negative. They're out. PE ratio 155. They're out. Now, you know what? That doesn't mean that these aren't good companies. It just means that I would not buy them at this time. So I just want to be very clear about that. Revity and Teleflex both have 0% dividend growth rates. They're out. Growth streaks are zero. They're out. Revity has I believe, a PE ratio that's a little bit too high. And this is my judgment. Some people may disagree. And let me say this: I have bought stocks that they had a PE ratio higher of their sector median if I had a really good feeling about it. But here I'm applying a very cut and dry rule because I want to be safe. I have scarce dollars to invest, and I want to feel that my investment is going to be safe, and I'm going to get growing holdings through an increasing dividend here. Because at the heart of this, I'm a dividend investor. What else did I eliminate? I eliminated Zimmer Biomet Holdings because I'll tell you, the dividend yield and the growth rate are just anemic, and the growth streak is only 1 year. Biotechne, same thing. And Viatris, same thing. And of course, the PE ratios are high. So, which ones got through on this page? Well, Baxter International got through. Okay, they're down 37%, but they got a healthy dividend yield of 3.6%. And I like that 5 year dividend CAGR of 10.6%. They got a streak of 6 years. The payout ratio is 41%. It's safe. Levered free cash flow margin, 7.5%. And I like that PE ratio, 12.35. It is cheaper than its sector median. So Baxter's in. Pfizer is in. And I was actually kind of surprised. We hear about them getting beat up in the market, but you know what? Take a look at some of the metrics. Okay, they're down 35% year to date. They still have a decent dividend yield, and part of that is because of the reduced price. But you know what? They're keeping up with that dividend growth rate, 5.13% at the 5 year CAGR level, 12-year growth streak. Very nice. And a 33.6% dividend payout ratio. I like that levered free cash flow margin. They're killing it. 15.85%. PE ratio 16.01, less than the 18.48 sector median. Quest Diagnostics. Quest Diagnostics is down 21.5%. Now, here you're going to see that the dividend yield is off green. It's not green, it's off green. And why is it off green? Because everything else is green. And the dividend CAGR more than makes up for the 2.31% dividend yield. Taken together, they are almost 10%. And that's my rule of thumb. And a lot of us dividend investors, we like to see 10%. So, we like to see 3% dividend yield, like to see 7%, dividend growth rate. This approximates that. They have a growth streak of 12 years of increasing their dividend, payout ratio 31.5%, levered free cash flow margin 5.9%, and the PE ratio is 14. They're in. Last one on this page, Bristol Myers Squibb. They're down 20.54% year to date. They have a wonderful dividend yield, 3.99%, and a dividend CAGR, the 5 year, 7.34%. They have a growing dividend, 7 years straight. Nice. And the dividend payout ratio, it's safe, 29.57%. Levered free cash flow margin, they are killing it. Almost 28%. That is a thing of beauty. That PE ratio is cheap, 7.76%. It's about a little more than the third of the sector median. So they're in. So Bristol Myers Squibb, Quest Diagnostics, Pfizer, and Baxter. Let's go to the next panel. Okay, and you'll see that the price decreases end after DaVita, and then we start to get into price increases. So what has been eliminated? Well, we eliminated Universal Health right there. The growth streak is zero. That's red. And Merck & Company, I was surprised. They have a payout ratio of 101%. I think for me, that's a little too high. The Cigna, not bad. The dividend yield's a little bit anemic. That dividend CAGR is huge, and I'd have to go into that a little bit, but they only have a growth streak of 2 years, so I'm going to say no. And then HCA Healthcare has a zero growth streak, so that's a no. LabCorp of America Holdings, 0% CAGR, 0 years growth streak. And you can see the red under the PE ratios. There's four of them that are red. Danaher, Merck, uh, Edwards Life Sciences, and we have Cooper Companies. They're all a little bit high for my taste. So which ones got in? Johnson & Johnson, the dividend king, 3.02% dividend yield, 5.92% Hagar, I love it. 60-year growth streak. That is a thing of beauty. Payout ratio 44%. It is safe. That levered free cash flow margin, they're killing it. 22%. PE ratio 15.7. It is a buy. Next one, Elevance Health. Elevance Health. When I think of these health insurance companies, I am thinking United Health. Elevance is really number 2 in market cap after United Health. They are down 9.82%. The dividend yield, it's a little anemic. Again, it's off green, 1.28%, but that dividend CAGR is killing it, 14.16% on average the last 5 years, increasing 11 straight years. Wow. Payout ratio, it's very safe. It's 17.66%. I typically like to see 20 to 60%, but you know what? They're close enough. They're killing it. I say yes. Levered free cash flow margin, 4.82%. If I have my druthers, I'd say, hey, if I'm on the board of directors, let's raise that dividend. Let's raise it. Let's increase that payout ratio. But you know what? I will take this. Next one, AbbVie. They're down 8.9%. I like that yield, 4.02%. They have a healthy 5-year dividend growth rate, 10.5%, increasing 10 straight years. Payout ratio, 46%. They are killing. Look at that levered free cash flow margin, 42%. That is amazing. I think that is higher than anybody in this sector. And look at the PE ratio, 13.3. It's a buy. Next one, Gilead Sciences. They're down 7.75%. A healthy dividend yield, 3.79%. Dividend growth rate, little under 6. Continuous increasing the dividend 7 straight years. Payout ratio 47%. Levered free cash flow margin almost as good as AbbVie's, 35%. And that PE ratio is beautiful, 12. I would grab it. Next one, Medtronic. And I have several shares of Medtronic, and they are down 7.68%. Dividend yield 3.85%. It's beautiful. And that dividend growth rate, 7.37%. So those are green. 9 continuous years of increasing the dividend. And the payout ratio, 51%. It's safe. Levered free cash flow margin, healthy 14.93%. PE ratio, 14. Medtronic is in. Those are the only ones that are in on this page. So Johnson & Johnson, Elevance, AbbVie, Gilead, and Medtronic. One more slide. And these are all the ones that have gone up, plus a few on the previous slide. I only chose one that has gone up, and it's Amgen, the drug company, headquartered in LA. And they are up 9.23%. Dividend yield, just an eyelash below 3%. Dividend growth rate, more than 10%, 10 and a quarter plus. Increasing that dividend 11 straight years. Payout ratio is safe, 45.81%. Levered free cash flow, they're right up there with AbbVie, 37.82%. They are a cash machine, just like AbbVie. And they're just heads and shoulders above everybody else in the sector median. PE ratio, 15.71, less than the sector median. They are in. So, folks, that is it. Those are the 10. I hope you found this video to be informative and enjoyable. If you'd kindly give us a like, consider subscribing to our channel here at Dividend Blasters. Till our next video, have a wonderful day. God bless.